What about when we have long-term operating assets that we're holding for sale or disposal, so we're not using them in operation? Let's take a look at how we account for them. It's important to note that US GAAP and IFRS have converged when it comes to the treatment of impairment of these long-term operating assets held for sale or disposal. The concepts and judgments that underlie accounting treatment of these assets are the same as those involved for accounting treatment of impairments for long-term operating assets. A company selling or disposing of an asset measures the asset at the lower of cost, carrying value, or net realizable value, which is fair value less selling costs. If a write-down is necessary, then the loss is equal to the difference between the carrying value and its fair value net of selling costs. If the company writes down the asset in one period and still holds the asset in the next period, then the company can report an increase in value in the subsequent period if the fair value net of selling costs has increased, or if it has decreased, you can have an increased loss. One other thing I want to mention is that companies do not depreciate or amortize these long-term operating assets if they're holding them for sale or disposal. So they're not using them in operations, they're reporting them at the lower of cost or fair value less selling costs. They have to report the asset as a separate line item on the balance sheet if it's material in amount. Let's take a look at an example. Okay, so what we have is a ALR, and they have land that's held for sale. The carrying value is $2 million. The fair value less any selling costs at the end of the first year is $1.8 million. A year later, the value of the land less selling costs has been estimated to be now higher than $1.8 million. It's gone up to $1.95 million. Let's look at the journal entries for this. The first journal entry, we need to reclassify the land as held for sale, and you see that by debiting land held for sale and crediting land. So it's no longer included in property, plant, and equipment. Land held for sale can be included as part of investments. The second journal entry will be the write-down, and so we show the loss on land held for sale, $200,000, and then we decrease the asset account called land held for sale. And so the land is reported at $1.8 million in a separate line on the balance sheet. The journal entry on the end of the second year shows that there's been a market recovery. The land held for sale goes up 150. That brings it up to its 1.950 estimated fair value less selling costs. And in this case, we have gain on land held for sale. So pretty much we're marking it at fair value less any cost to dispose, and we're showing the gains and losses in the period that they happen. Let's look at a slightly different example. So it's still ALR, we have the land, it goes from 2 million to 1.8 million at the day that we do the estimation, and so they've not sold it. We go ahead and we have to show the journal entries. But at the end of the second year, the value has increased to $2,050,000. Note this is higher than the original 2 million carrying value. So let's take a look. So we reclassify the land held for sale and debit that, credit the land. We show the loss on land held for sale, the original $200,000. Nothing changes there. In the following year is when we see a slight change. We are limited to writing up the land held for sale to its original carrying amount. So even though it looks like it should be a $250,000 gain on land held for sale, we are limiting that, so we only write it up as far as the carrying value. So land held for sale goes up to $200,000, and the gain on the land is shown as $200,000. On the balance sheet on December 31st, 2019, it'll be shown as $2 million in a separate line. So that is the original carrying amount.